Hi, everybody. Welcome to the Lee Seminar Series. I'm Dr. Scott Graw. I'm the Dean of the College of Business here at Mississippi State University. And we're thrilled to have everybody here in the room and streaming live. So before we get started, I do want to take just a minute to introduce Dr. Tom Miller. He is the inaugural holder of the Jack R. Lee Chair in Financial Institutions and Consumer Finance, and we're thrilled that he is here to moderate this session. I'm going to let him introduce our speaker today, the Honorable Dr. Beales. But I also want to give a special thank you to Mr. Frank Lee, who has been a tremendous host, sponsor, and supporter of this program. He's helped us, host many different speakers over the years. So without further ado, I'm going to pass it over to Dr. Miller.
Thank you, Dean Graw. So he actually just covered the first page of my notes here, but I am Tom Miller, and I am proud to be the inaugural holder of the Jack R. Lee Chair here at Mississippi State, and I am the moderator for today's events. And you'll notice that we have, usually we have a person here, but the planes out of D.C. were delayed such that Howard is live at home today. So, but through the Lee Chair, we have this idea to bring distinguished speakers to Mississippi State University to discuss research and current events at the crossroads of law, economics, finance, and regulatory policy. So again, to start, I really do want to thank Mr. Frank Lee. He's helped me plan, host, and enjoy the Lee speakers since 2012, actually. So it has been a long time that we've been doing this. Last year, we were joined by Dr. Michael Falkender, a former Deputy Secretary of the U.S. Treasury. That taped event is available on my page at the website at Consumers Research. But today, we are delving into the world of the current state of consumer finance regulation and possible paths forward. This topic is quite broad, and in many circles, it is contentious. Our conversation today will mainly focus on providing some information to the listeners so that they can get a look behind the scenes at what is going on in consumer finance regulation today. As customary in this series, lurking in the background is the question of whether consumers are best protected through the centuries-old process of market intervention or through a rigorous regulatory oversight, or possibly a combination of these two protections. I will now introduce our guest and briefly list some of his many career accomplishments. Dr. Howard Beales is an emeritus professor of strategic management and public policy at the George Washington University, where he taught from 1988 through 2019. His research interests include a wide variety of consumer protection regulatory issues, and he has published numerous articles on these issues in academic journals. Howard has worked at the Federal Trade Commission as a staff economist and later served as the director of the Bureau of Consumer Protection at the Federal Trade Commission, where he focused on the use and misuse of consumer information. During that time, the FTC implemented the National Do Not Call Registry. Most recently, Howard served as a member of the Consumer Financial Protections Board's Taskforce on Financial Consumer Protection Law. Howard was a primary author of 2 chapters of this task force report, and those chapters focused, not surprisingly, on 1, information and disclosure, and 2, privacy and data security. Dr. Beales graduated magna cum laude from Georgetown University with a BA in economics in 1972 and received his PhD in economics from the University of Chicago only 6 years later in 1978. It's my distinct honor and privilege to have Howard join us today, so please join me in a hearty bulldog welcome to our guest.
Thank you very much, Tom.
So one second there, Mr. Howard. So here's today's agenda. Howard will make some introductory remarks, and then following that, he and I will engage in a fireside chat. We should have another screen with a fire anyway, concerning various topics in consumer protection. Then we'll have a short Q&A session from the live participants here, and then we have a reception following with ice cream, coffee, and soft drinks. So, I'll turn the floor to you, Dr. Beales.
Thank you very much, Tom. I really appreciate the invitation, and I'm so sorry I can't be there in person. It doesn't sound like the reception will be quite the same from my point of view here. I thought I'd take as my theme today deregulatory turmoil. There's always policy and turmoil when a new administration comes to town, but it's intensified in the last 20 years as regulatory agencies have increasingly been willing to change longstanding legal positions. Maybe one of the most outstanding examples of regulatory whiplash, as some have called it, is at the Labor Department, where longstanding interpretations of the Fair Labor Practices Act had been in place from the time the acts were passed in the 30s until the Obama administration. And then, as a result of a series of court decisions in private litigation, where the Obama administration didn't think the right side was winning, they decided to completely change their legal position. That lasted until the end of the Obama administration, when the first Trump administration changed it back. The Biden administration changed it back to the Obama status. And you'll never guess what the second Trump administration is doing with those rules. But there's some important structural differences now that are making changes in the way that policy change unfolds. Even before Trump took office, the legal landscape had changed. The Supreme Court has enunciated the major questions doctrine, which says it's Congress that has to decide major questions of public policy, not the executive branch interpreting statutes passed long ago. Secondly, the Supreme Court ended the deference to regulatory agency interpretations of their own statutes in the Loper-Bright decision. Now the courts are going to determine the best interpretation of the law, and hopefully it won't flip-flop with every administration. The impact of those developments is still unfolding. In particular, the Trump administration wants to use the Loper-Bright decision to avoid notice and comment rulemaking in a number of cases. What will happen is agencies will argue that the original rule was not authorized under a proper reading of the statute, and because it wasn't legal in the first place, comment isn't necessary to get rid of the rule. It's not clear how well this will work, and it certainly is a risky strategy in terms of actually getting changes that stick. Trump made two changes that are significant in the consumer financial world at a structural level. One is he extended the executive orders governing federal regulation that have been in place since the Reagan administration to cover independent agencies. They'd never been covered before, so they weren't formally subject to the executive order requirements that agencies only regulate if the costs were sufficient, or if the benefits were sufficient to justify the costs. Those determinations are also subject to review in the Office of Information and Regulatory Affairs, which is part of the Office of Management and Budget, and reviews those regulations and their associated cost-benefit analyses to see whether or not they're consistent with the executive order. This is really a sea change in consumer financial regulation, which has generally been done by independent agencies. In particular, the CFPB is now subject to this new process, and OIRA has already reviewed 9 rules as of the end of August. The second structural change was DOGE, the Department of Government Efficiency. For most career employees, a federal job has probably had more job security than anything except possibly academic tenure. The direct impact of DOGE was fairly limited. It was a relatively small effect on the overall size of the government, but the effect on employee attitudes was more widespread. Career employees see their jobs at risk in a way that they never really did before. I think the other thing noteworthy about deregulation in the Trump administration is simply the pace of change. We've never seen an administration that moved this rapidly on as many fronts as the current administration has moved to change the regulatory landscape. Even in the Reagan administration, it was a month before Ronald Reagan issued the pivotal executive order that established cost-benefit principles to govern regulation. An interesting question for the Trump administration, both times around, has been what to do with the CFPB. It's really confounded both Trump administrations. In the first administration, they waited for the director of the CFPB to resign. It was formerly an independent agency. The statute said he couldn't be removed except for cause. And the director stuck around for just over a year after the election. As a result, the Trump administration had to deal with a payday loan rule that had been adopted, as opposed to only a proposed rule, which was its status at the time Trump took office. Trump, too, is confounded in a different way. Initially, they tried to lay off most of the Bureau, the CFPB staff. The problem with that is if you've got no staff, how can you undo some of the bad things that the Bureau did at the end of the Biden administration? And there were a number of those, and I'm sure we'll talk more about them over the course of this afternoon. In any event, the layoff efforts were stayed in court. The DC Circuit recently ruled against that injunction, allowing layoffs to proceed, but the petition for en banc review is pending. So what will actually happen, whether those layoffs will actually proceed, remains unclear. The president nominated a director for the CFPB, but that nomination was withdrawn, and OMB director Vogt is now the acting director. And the CFPB has also been active. It has been withdrawing rule proposals issued at the end of the Biden administration. It's been withdrawing guidance documents that it thought imposed new requirements not present in the statutes or rules. And it's been initiating rulemakings to revise some other Biden era rules. Those sorts of efforts require people. So it seems likely that the CFPB will remain. But as I said, the administration's response, if and when it can proceed with layoffs, isn't at all clear. With that introduction, Tom, I look forward to your questions.
Oh, thank you, Howard. That's very well done. So let's just continue with the CFPB while it was fresh in our minds here. So what do you think are the big hurdles or rules that need to be rescinded or changed or what have you?
Well, they've already done a lot of the things that most needed to be done because there were several very far-reaching proposals at the tail end of the Biden administration that were still proposed rules and had not been promulgated. For example, there was a proposed rule about data brokers that would have extended the Fair Credit Reporting Act to include a number of data brokers. It would have amended the permissible purposes for getting a credit report, and it would have regulated the dispute resolution process. The Trump administration withdrew that proposal and isn't likely to proceed with it. There was a proposed buy now, pay later interpretive rule that said the Bureau was going to treat buy now, pay later loans as credit card loans. But they're not. They are closed-ended loans, not open-ended loans. There's typically no interest on buy now, pay later products. So this was a very far-reaching change in the way those products would be regulated. Again, the CFPB withdrew those rules, that proposal, and has said it's not going to write a rule in this area at all. One other thing that the Bureau is reconsidering, and I think is an important rule, is the rule governing financial data rights that gives consumers access, the right to access their data in electronic form. And that too, I think, is one that is ripe for change, and where the Bureau has started the process.
So is that the 1033 rule, Howard?
It is.
Okay,
it is.
So I actually have an exhibit, our first ever exhibit in the Lee Speaker series. Here is the Rule 1033, or not Rule 1033. This is the page out of the Federal Registry of Section 1033 of the Dodd-Frank Act. So as you can see, it's one page. The rule that emerged out of the CFPB is slightly longer, that's 850 pages roughly. I didn't bring it along with me, but so it's a very complicated rule, and the idea is that basically consumers should be able to switch their data from financial institution to financial institution and other things. Howard is actually an expert on 1033, and I am not, but so you can just maybe explain a little more, if you would, about the far-reaching effects of 1033 on various constituencies.
Well, that was the core idea: is give consumers access to their data in electronic format, basically so they could take it somewhere else. What was happening in the marketplace was there emerged a number of data aggregators that offered various specialized services to consumers. Initially, the main product was essentially a display where you could look at all of your financial institutions in one place, in one format, even if it came from different financial institutions, because you had accounts in a lot of different places. The way people implemented that was by getting the consumer's credentials. I'd sign up with a data broker if I wanted this service. I'd give them my username and my password for my bank account. They'd sign in as me and have access to my information, which they would then use screen scraping techniques to capture that information so they could deliver their product. That's a very fraught practice because it poses all sorts of security risks. It really is giving the data aggregator the keys to the kingdom of my own finances. Banks hated it because they're the ones that are on the hook for security problems. And what emerged was a different way to get access to consumers' data, which is an application programming interface, an API. And basically, that lets a properly authorized data aggregator or any other third party access the financial information that the consumer has authorized, but do it directly. And it's much easier to control. It's much less subject to the security breach problems that freely distributing your username and password can create. The rule as the CFPB originally wrote it would have said that essentially anybody could be the consumer's representative and ask for this access with the consumer's permission. That access had to be for free. There could be no charge for it. And it could only be used narrowly for the particular purposes that the consumer had specifically authorized. In the advance notice of proposed rulemaking to make changes, the Bureau is specifically asking about about fees and whether fees are appropriate, about the breadth of access, who should qualify as the consumer's representative, and about privacy and security risks.
Okay, let's just change a little bit to the fintech area, if you don't mind, and let's just
Sure.
talk about the latest in fintech and in financial markets, especially lending.
Sure. Fintechs probably had their first major impact in consumer lending markets, and what's happened with fintechs is they've really expanded access to credit, and they've done that through the use of non-traditional data to assess credit risks, and that includes things like cash flow analysis and payments that aren't typically part of credit reports, like rent payments, utility payments, telecommunications services. What that did for the fintechs was enable better risk assessment models, often built using artificial intelligence and machine learning. And everybody I've ever talked to in the online lending space thinks that their own risk assessment model is the secret sauce that's the key to their business. The problem for those institutions is the regulatory structure, because like other installment lenders, they're subject to regulation at the state level, not at the federal level. And that means that they have to comply with the usury laws in particular of each state in which they do business. Now, that's hard because the laws are all different, the details are all different, the interest rates are all different. It's very hard to offer a uniform nationwide product, which is obviously what a national fintech company wants to do. um, there were a couple of different workarounds that emerged for that problem. The most common one was a fintech would partner with a national bank or with a state chartered bank, and what the national bank or the state chartered bank offered was the ability for preemption. If you're a national bank, uh, the you're subject to national regulation, obviously, but you only have to comply with the state consumer protection laws of your home state. You don't have to have different, you don't have to comply separately with the laws of the other 49 states. That's a huge advantage. It's the way the credit card market has operated for a couple of decades, with national banks exporting, if you will, the regulatory structure of their home state in order to offer a product that's uniform nationwide. A lot of fintechs did that when in partnering with a bank one way or another. And many of the banks that they partnered with were state chartered banks, which have the same ability to extend preemption and only comply with the consumer protection laws of their home state, rather than other states. In the first Trump administration, there was interest in a different approach, and that was to nationally charter fintech companies with a special kind of national bank charter, was the idea. A national charter, by its nature, would be preemptive. You'd have to comply with the national requirements, but you wouldn't have to worry about the varieties of state law. Um, Initially, there were legal challenges to the comptroller of the currency's ability to do that, and essentially there were no takers. Then in the Biden administration in 2022 and 2023, excuse me, the financial regulators launched essentially a crackdown on the banks that had been partnering with fintechs, trying to impose tighter oversight and stricter lending standards than the fintechs wanted to adopt, and leading many of the banks that had been partners to exit from the field. It was no longer worth the trouble. That made the charters more attractive. And the current Trump administration has made clear it's a lot more willing to entertain requests for a national charter from fintech companies. Since the beginning of the year, there have been 20 applications for federal banking charters of various forms, and several of them have already been approved. I don't know of anybody that's in operation yet, but that's surely going to be coming, and there's surely going to be more applications. One law firm called 2025 the year of the bank charter, because of the surge of fintechs applying.
So what will be the long-run impact of having these new fintechs enter the lending market through this national bank charter?
Well, I think much of it is as what we've already seen, is expanded credit access to people who otherwise couldn't get credit, because of better underwriting models and better risk assessment models, and just more competition. And more competition is virtually always a good thing for consumers.
Okay, so I know that in that space, there's a lot of fraud activity, this organized fraud, that there's people that will try to open 1,000 loans at once and default, not just onesie twosies. But so that is a big problem that space has encountered and will continue to encounter unless they can be one step ahead of the fraudsters somehow.
Well, and that's a problem for everybody that does business online. And the fraudsters will keep trying new tricks. The lenders and potential lenders will keep adopting new strategies to try to defeat those tricks. And so far, at least, although I'm sure there have been losses, they haven't really impeded in a serious way the growth of that form of lending, which is getting a larger and larger share of the market.
Okay, do you think that'll have an effect on the tribal lending? Will tribal lending fall as a consequence of this? Or are they a separate and distinct source of credit?
Tribal lending was an alternative way around the disparate regulatory structures. Because the argument of the tribal lenders is we, the tribe, are a sovereign nation. We don't have to comply in our commercial activities with the laws of the different states as long as we comply with our own laws. And lenders who were licensed by a tribal entity argued that was the only regulatory structure they had to worry about. To some extent, the national charter is a substitute for that. I don't know which is going to be more valuable to fintech lenders, or which is going to come to predominate. But they're surely substitutes, and we'll just have to see which one ends up prevailing in the marketplace, and maybe they both will in various forms.
Okay. So if we look down the road at the current structure of the CFPB and other federal agencies, do you see any kind of merging that will take place, or ones will be absorbed by the others, or will they remain separate and distinct entities, in your opinion?
I think the most likely outcome in the political process is inertia. Things will stay pretty much the same. But I think there is a real risk, a real possibility of some consolidation. And I worry in particular about the Federal Trade Commission. There's always been a push to consolidate antitrust enforcement at the Justice Department. And with the CFPB, that could take over the consumer protection functions of the FTC, and then you don't need an FTC anymore. But abolishing an agency is a very difficult thing to do. In the Dodd-Frank Act, in the wake of the financial crisis, I think we had 7 different financial regulators, and Congress managed to get rid of exactly one of them. So I don't see a lot of consolidation coming, but there is the possibility of at least some.
Okay, but going forward then, you think that the missions will change at say, at the CFPB or the FTC's Consumer Protection Divisions?
Well, I think both of them now are a lot more market-oriented than they were in the Biden years. They recognize markets as a key form of protecting consumers. They see their role as enhancing market performance rather than trying to replace markets with regulatory dictates. And I think that'll certainly continue for this administration. I have no idea what the next Democratic administration might want to do, but I think the market-oriented approach is certainly the better one for consumers.
I agree with that, obviously, but so in terms of are there any big rule makings on the horizon that I know the CFPB is like retracting rules, but are there any big pushes that you know of on consumer protection regulation that is being ginned up?
Well, there may be some at the Federal Trade Commission. The uh, the negative option rule that was adopted at the end of the Biden administration, and what it said, in essence, was the cancellation process when you sign up for some subscription has to be just as easy as the sign up process for the consumer. There were serious procedural problems with the way that rule was adopted. Basically, the FTC ignored the statutory requirements for the processes it was supposed to follow. And that led to the rule being sent back to the FTC. And there's likely interest in revisiting that rule, probably at a more sensible form, because there are legitimate reasons why it's harder to cancel than it is to sign up. I mean, the clearest example is the home security service. You really don't want the crook that wants to rob your house to be able to call up your security monitor and cancel your subscription. So it's going to be a little bit more elaborate because the service provider needs to be sure who they're dealing with. But in any event, before it could proceed, the FTC would have to fix its rulemaking processes. So that's something that is down the road if it happens at all. And I don't know that there's. I think I think at the FTC in particular, they are much more interested in case-by-case enforcement against bad actors than they are in trying to write new rules.
I think that's a good focus personally. Uh, but
Well, so do I.
yeah, right. So maybe we could just talk a little, or more than a little bit, but let's delve into the task force that you were a part of, and if you could explain the structure of it. I could work through the background of where, the grandfather of this commission, but I'd like you to talk at length about that because I think that's a very, very important report, and it has had no sunlight shown on it. And you can tell I'll leave you to tell us the date that it came out. So.
Yeah, the task force was 5 people. It was a consensus report that all 5 of us agreed to. It issued a report that was about 800 pages. There's a separate volume of about 100 specific recommendations for what federal consumer financial law ought to look like and where the regulatory agencies ought to be heading. It was developed over the course of 2020. And unfortunately, we released the report on January 6th, 2021, a day when certain other things were happening. It got very little attention at the time. When the Biden administration came in, they weren't terribly interested in the recommendations that had been developed during the first Trump administration. And so it never got a lot of attention. I think it deserves a lot of attention. It was set up as a follow-on to the National Commission on Consumer Finance, which issued a very influential report on the state of consumer financial regulation in 1972. And the 2020 task force was conceived as a follow-on and reevaluation of the work of the NCCF. I hope it gets more attention in terms of what the financial regulators ought to be doing. But for example, one of the things it said was, "Gee, we really ought to pay some attention to national chartering for fintechs," and some of that is actually happening.
And actually, there's, in my opinion, the 101 recommendations are just ripe for academic research to look at these recommendations and push them forward and say, what can we contribute academically on the questions, on these recommendations? Are they good? Are they bad? How can they be strengthened? Or are they not needed? All those things we ask in research, I think, can be applied to those recommendations. And the chapters, I've read the whole task force report, and it's really well written, actually. It is 800 pages, but it is well written, and I enjoyed it. And I read the National Commission of Consumer Finance report as well, which was published in 1972 under the Nixon administration. And it was part of the Truth in Lending law that was passed, what was the name of that act, Howard, where the TILA was part of that National Consumer Credit Act or something like that?
Yeah, the Consumer Credit Protection Act, I think.
Yeah,
Something like that.
Something like that, and it had 4 different parts, and one of them was Truth in Lending, and one of them was this commission, and the whole bill was 27 pages long. So that was before the days of electronic word processing and what have you. So, but this report, Todd Zawicki, who was a former Lee speaker, was the chairman of the task force, and Tom Durkin was on that task force, was he not?
Yes, he was.
And he was a former Lee speaker, and Gregory Illhausen was the economist for the task force, and he was a former Lee speaker. So our fingerprints are all over that task force in some sense. But I'm a big believer in that because it took us 50 years to revisit that National Commission of Consumer Finance report, which was really influential and helped shine a light on what's the state of consumer finance in the United States. And I think this task force report of 2020 gives us a fresh look of where we are now, but more than that, where we should be going, and lays the groundwork for academic research, in my opinion, on many of these areas.
I would certainly hope it would. I think there's a lot of fertile ground there in both the recommendations and in the discussions of the state of what we know about consumer credit. Especially if you're an academic and you read it and there's things in there you disagree with, well, generate some evidence. And let's learn more about how these markets actually operate and what the effect is. You should maybe consider as future Lee speakers the other 2 members of the task force, Bill McLeod, who is a former FTC bureau director as well, and Gene Noonan, who was at the FTC and also at the FDIC, I believe.
Duly noted. Yeah, okay. So I just want to kind of close by where you started, and think about the regulatory whiplash or just kind of the turmoil that's going on now. Is this turmoil going to continue for the next 3 years foreseeably, or will it kind of become, like you said, inertia will kind of take over and it'll slow down naturally? Or how do you see it evolving, I guess, in the next 3 years?
I think the pace will likely stay fairly frenetic for the next 3 years. I think the thing that is really going to tell the tale is how do some of these efforts fare in the courts. And as I said at the beginning, we don't really know how the court is going to apply the major questions doctrine, which could well apply to many things in consumer finance and potential consumer financial regulations. And we don't know how it's going to implement reviewing statutory interpretation by agencies, where there's historically been great deference to the regulator's view of what it was that was allowed and not allowed under the statute. And how much change there can be is going to depend on the answer to those questions. I think it seems clear the Trump administration is going to push the envelope, but the nature of rulemaking and then litigation about the rule is it's going to take us at least 3 years to figure out more about the answers.
Yeah, no kidding. And it's like it'll take some time for Loper Bright to work its way through the system as well, I think, so.
No, exactly. I think that's exactly right. It's just not clear how it's going to be applied, how strict the courts are going to be in reading the statutes, and how much they're going to pay attention to what the regulators think. I do think it's likely to be a force for stability, um, because I mean, one of the things the court said was, executive interpretations of their authority are more persuasive when they're at the time the authority was granted, and they're more persuasive when they are well reasoned, and those are things that uh, you can't go back and reinterpret from the beginning again. So, the interpretation at the time is going to be more influential and more stable than an interpretation that comes later, or a reinterpretation that comes later.
Okay. Do you have any closing remarks that we touched on that you'd like to clarify or restate or?
No, there's one other thing we should maybe talk about if we have
Okay.
time briefly, which is the role of fintech in payment services.
Oh, yes.
Um, but,
No, let's.
okay, what's happened? In addition to their presence in the consumer loan market, fintechs have become important payment service providers, moving money from one place to another, from one person to another, from one financial institution to another, or the like. Traditionally, the payment system in the United States runs through the Federal Reserve. And in order to access the Federal Reserve payment system, you have to be a bank. What the Federal Reserve System was built in an era of paper checks. It contemplates paper checks. It still contemplates paper checks, even though paper checks are an increasing rarity in modern finance. But that's still what the system is built around. And it's kind of slow, it's costly, and it's cumbersome. It can take, I mean, it's the reason banks put holds when you deposit a check, is because it takes a while for the check to actually clear through the Federal Reserve's system. What's happening with fintech is they're moving money through digital assets. And the Genius Act that just passed earlier this year is something that's likely to facilitate that considerably. And basically, the way the process works is this. A fintech offers you an account that's denominated in dollars. They use the dollars to buy stablecoin, some digital asset. And the thing about digital assets is they are really easy to move to somewhere else. And the fintech can, if you want, move that digital asset to a different financial institution very quickly, where you can convert it back into dollars, all at a fixed exchange rate, essentially. It's a much quicker and easier process. I was at a conference just last week with a bunch of people who had recently moved to the U.S. from Brazil and were trying to establish U.S. bank accounts. And the people who did it the conventional way, by writing a check on your Brazil bank and depositing it in an American bank, the process of getting a U.S. bank account took 4 or 5 days. For the people who did it through a fintech provider, it took 10 or 15 minutes. So it's a much easier process, and fintech is likely to be an increasingly prominent part of the payment network in the way money actually moves from person to person and around the economy.
Okay, so are there money laundering issues, you think, with this new technology, or not so much? There's nothing new introduced.
There's nothing new. I don't think it. I suppose there's some increase in risk because the easier it is to move money, the more you can shuffle it around, and that presumably makes it easier to conceal nefarious transactions. But it's hard to say that you could only actually exchange currency because otherwise there might be fraud. uh, that's just that's way too restrictive.
Sure.
There will be risks that emerge that banks and the fintechs providing these services will have to watch out for. They're not going to be, as I understand it, exempt from money laundering requirements. They're still going to have to report suspicious transactions.
Okay.
But the mere fact that money can move more easily may, and I emphasize may, make it easier to shuffle the money more in a way that makes it harder to follow.
Okay. Okay. Great. So do you have any other comments or that you'd like to point out at this time before we turn to the audience for Q&A?
No, I look forward to questions.
Okay. So we have some microphones around. And see, everybody in Mississippi is doesn't want to be a question bullying, be first, so we're always polite and want to go second. But here, okay, yes.
And let me take a moment to introduce myself. My name is Kathleen Thomas, and I'm the Department Head of Finance and Economics. And so on behalf of the department, Dr. Beales, we're really glad that you can be here with us today, even if it is virtually. And so thank you.
Well, thank you, and I'm sorry we didn't get a chance to meet in person.
No, of course. Well, we are too. So I wanted to go back to the first topic about aggregating the financial data for consumers because I found that fascinating. And as one who really receives no utility out of maintaining Excel spreadsheets of financial data, I love the idea that if there could be a safe way to aggregate the financial data so consumers could have that, just information kind of at their fingertips, that, the opportunity cost of my time is high. And again, I don't get utility out of doing it. I'm sure Dr. Blank and Dr. Miller would be like, just open up your own Excel spreadsheet. But I just thought that perhaps, you could give us some insight into where you see that, if there is space for that, where it could be a safe tool. I know as a consumer, I would be willing to pay for that service, and I would just love to hear a little bit more about that.
There are a lot. I don't know the extent, but there are certainly a lot of financial institutions that are already doing that. My broker, I can add in extra outside accounts and link external accounts, and they'll all show up in whatever analysis the brokerage account is doing. My bank offers that same service. It started with third parties who said, gee, consumers would like this. There are consumers like you out there who are willing to pay us for this service. But it has spread. It has spread, and with a sensible 1033 rule, will likely spread even more among other financial institutions, because it's a great convenience for consumers.
Todd, Dr. Jones has a question.
I'm pretty interested in the buy now, pay later stuff. But I don't know a lot about it. I've kind of been reading some articles in the New York Times and whatnot, and how people can kind of get really addicted to this and that kind of thing. So I was wondering if you could just talk a little bit more about maybe how you see the future of this being regulated.
Sure. I think in many ways, as the Biden administration, the Obama administration, and then the Biden administration both put considerable pressure on small dollar lenders. They really didn't like payday lending. That was a central feature of the Obama CFPB was a rule addressing payday lending. And one of the things, and I think that pressure is one of the incentives that led to the development of buy now, pay later, because it's essentially a substitute for that sort of short-term installment credit. The typical buy now, pay later is you buy the good. It's at a merchant. The merchant has an arrangement with somebody who's going to finance the transaction, and you pay for the transaction in typically four installments, with no interest charge and no fee. I mean, whatever there is built into the price of the product, not something extra. And it's a very convenient form of credit. It functionally, it isn't any different from a credit card that you pay off regularly. You get the goods now, and it's the end of the month or next month before you actually have to pay for them. But with a credit card, you have to do it in one lump sum. And buy now, pay later lets you spread it out over four payments. Now, not uncommonly, those payments are only 2 weeks apart. And typically it's done by automatic withdrawal from your bank account. And that was actually one of the issues of concern in the for the buy now, pay later folks in the payday loan rule, because they're short. If it's a 2 week interval, they're short enough loans that they're covered by the payday lending rule. Short-term credit or liquidity credit or credit card credit, for that matter, has always been controversial. And with any form of credit, people can and some people will borrow too much, and that will get them in trouble. There doesn't seem to be, to me, anything about buy now, pay later that makes it any more prone to that problem than credit cards or any other form of short-term credit. And the improvements, the underwriting that's done is almost all alternative underwriting in buy now, pay later. It's not sort of literally anybody. There is an underwriting process, but it uses unconventional data and unconventional approaches and doesn't look like traditional bank lending at all. So I think this is a really good thing for consumers. Being able to borrow short term to get goods that you need now is a very appropriate and valuable use of credit. And most users seem to be using it appropriately. There actually is some evidence that's emerging that people tend to prioritize, when they get in financial trouble, people tend to prioritize their buy now, pay later payments over other payments. Not completely clear why that is. Maybe because of the implicit threat, if it's that is likely there at least, that you'll lose the goods. But that seems to be the empirical finding, is that consumers pay buy now, pay laters first, and then try to cover their other obligations.
We have Bo Brunson from Consumers Research has a question.
Well, I'm going to piggyback off the last question, or the topic, because it was a question I've been wanting to ask on this, and since you're here talking about buy now, pay later, how are lenders making money in that? I cannot figure that out.
How are lenders making money?
Universal question.
Lenders are making money because lenders are making money from the retailers in part, is the typical arrangement. And what's in it for the retailer is selling goods that they wouldn't otherwise sell. And so they're willing to pay something to the credit provider in order to make that available, and thereby sell the goods. It's not. Um, there's not a particular discount. I mean, the money's not coming from the consumer, except insofar as it's built into the price of the goods. I think it's largely coming from the retailer, who's paying in the same way that they pay with any other promotion to get more people to buy their products.
And now I'm going to ask my real question, and I'm going to ask you to put on your privacy hat back on. Do you think that we need a national privacy law? I mean, we kind of already do now because we're living under GDPR and California's privacy laws. Is that a failure by the federal government to not have a unified federal law on privacy?
It has all the same problems that I talked about with fintech regulation. At the moment, there's only 3 or 4. Well, I guess we're maybe up to 10 or 12 states with privacy laws, and it's going to get increasingly complicated to try to comply with all of them, and that really is a failure. That the only way around it is a national law that's preemptive, and doesn't let states do additional or different requirements. In that sense, it's a failure. I think a national law that codified anything like the approaches in California or some of the other states would itself be a failure. I think the whole idea that we try to regulate privacy by pretending that consumers read elaborate privacy policies and make careful decisions about who to deal with based on what that privacy policy says, I think people just don't act that way. They're not paying attention to the privacy policies. They're not particularly worried, most of them, about what's being done with that information. The privacy risk that's inherent in you might get the wrong ad seems to me to be a really small privacy problem.
Actually, one of our previous lead speakers, Marcus Coles, who's the dean now at University of Notre Dame Law School, called that rational ignorance, and that don't read all those software agreements because somebody has. And so you're just free riding off of somebody else reading all the rules that, we just checked a box, and I guess we're all owe Microsoft everything at the end of the day. I don't know, but so we're approaching our hour. Are there any one last question?
I do have one question from online.
Oh yeah, okay. I was looking for it.
This was a question if, talking about think about Dodd-Frank was passed in 2010, and then 2 years later the iPhone 5 came out and everyone stopped going to their banks and stopped carrying their banks with them in their pockets, or started carrying their banks with them in their pockets. Does federal law no longer work in the age of technology? Can we not regulate at the speed of technology, and we've got to figure out a new way to do things?
Well, I think federal law has been perhaps surprisingly, but has been remarkably adaptive to changes in technology. There is no federal law about conduct on the internet, but the laws that govern fraud anywhere else in the marketplace or deceptive practices anywhere else in the marketplace have adapted very well to address those problems. I don't know of some problem that resulted from the fact that that people have their bank in their pocket that need to be addressed. I don't know what problem. I guess the question is, what problem are you concerned about? Because I don't know why there's the existing protections for your financial information don't do that adequately, even as the technology changes. The problem with technology-specific rules is when the technology changes, the rule is immediately obsolete and very hard to change. We're starting to see, we're on the edges of seeing that, I guess, with driverless cars. I mean, why does it need a steering wheel and pedals? But federal law requires a steering wheel and pedals. And that was appropriate for one technology. But it's like saying cars still have to have a buggy whip holder. The technology's changed and made some of that obsolete, and it's good that we can adapt to those changes.
Okay, well, thank you so much, Howard, for agreeing to join us, and we were able to do this webinar with you thanks to your patience with us, and we really wish you were here, and we do have some things we're going to mail to you, so otherwise, if you were here, we would hand them to you, but you're not, so we will use the, well, probably not, well, we'll use one of the delivery services to get you what you want. So I want to personally thank you, and I look forward to seeing you in the days ahead, sometime in DC somewhere, at some conference or panel or what have you. So thank you so much.
Well, thank you so much for having me, and again, I'm sorry I can't actually be there.